Welcome back to another episode of the Strive for 25 podcast. I've got an amazing guest on today, Mathew Pezon. And this gentleman has done a lot in his young life, real estate, YouTube, social media, just all kinds of stuff. But Matt, thanks for making time today.
Thank you so much for having me.
If you could give our listeners a quick overview of all the things you have going on.
Yeah, sure. So I'm a full-time real estate investor. I buy and hold properties. I really don't flip or wholesale, although I do if the deal calls for it. And I'm a father of three young children, three under three. So family, business. I have some philanthropy stuff that I'm doing as well to help others learn real estate investing. So all in all, real estate family and happy to be doing it.
So when did you get into the game? What year was it?
Yep. So I started in 2014 and maybe going back a little bit more. I was a full-time employee before that from 2010. I graduated from engineering school and my first boss out of school told me I was the worst employee he ever had and the company should fire me. And at that point, I knew that I needed to rely on someone other than an employer. So I learned about real estate investing and bought my first house in 2014. And fortunately, it was a good time to start buying.
Take a quick second and kind of fast forward. So right now, how would you describe your portfolio in terms of
Yep.
just
So
what it is and how many units?
Yep. Yeah. So my portfolio consists of around 200 units right now in the Lehigh Valley, Pennsylvania market. It's about an hour and a half west of New York City, about an hour and 15 minutes north of Philly. And yeah, just mostly buy and hold and long-term operator.
So the job that you mentioned, your boss telling you worst employee ever. What type of job was that?
That was an engineering job. So when I graduated from college, I was chemical engineering and I was put in an IT type role. And so there weren't procedures, weren't processes, weren't how-to documents really on how to do things. It was kind of sink or swim. And I wasn't prepared. I had studied something completely else, but I was thankful to have a job. And looking back, it hurt at the time. And I had 50 grand of debt. I had to figure out how I was going to pay for all this. What if I get fired? How am I going to get another job? All this. And fortunately, it didn't go that way, but it taught me from a young age about having multiple streams of income, the importance of business, not relying on any one customer. And I learned a valuable lesson from a young age.
So over 200 units, and you got started in 2014.
That's right.
The first one you bought as a primary residence?
Actually, the first one I bought was a rental. So I was still renting, but then I bought a single family house for someone else to rent from me. So, and the reason was that my girlfriend, fiance, later wife now, we were kind of living cheaply, frugally, and we, just wanted to put the money into investing rather than buying a primary residence and increasing our housing costs right out of the gate. So my first real estate purchase was a rental for another family, actually.
So can you break down how much you were paying in rent versus, some details on the purchase price of the property you got?
Yeah, sure. So at the time, she and I had met, I think, 2 or 3 months before. So we were still living separately at that time. But so I was paying, I think, $300 or $350 a month rent from, I was basically living at a friend's house, kind of like his downstairs bedroom, basically in a basement. So I was living pretty frugally and, at 350 bucks a month, if we were looking at buying and we would have increased our cost to maybe 12, 1300 a month, she was still evaluating coming out to this area near me. So it just made sense to look to buy. I rented that first house for 1,000 a month. And I thought to myself, well, if I can collect 1,000 in rent versus not having the property and increasing my costs up to 1,200, why would I do that? Like, let's just kind of get this first house, right?
What
So,
kind of price range was that one at?
yeah, I think I paid $60,000 for that one. It was in Allentown, and I sold it later for I think 110 or 115,000, maybe 6 years later. So, and then I just reinvested the proceeds. So,
So from a nuts and bolts standpoint of process, right? So, you're
mhm.
in your early 20s, I think, right? And during that time,
At that time, yep, I'm 36 now, but yep,
36 now.
yep.
So in your early 20s, you got a job, paying rent, go buy
Hmm.
a rental property for in the 60,000 range.
Yep.
Do you go get a conventional loan? Do you go get a private money commercial loan? But how do you get a loan like that? What's
Yeah,
the
so I got a conventional loan. I put 15% down, and then the rent was 975 or 1,000, so it just paid the cost of the loan. I think it was like 200 and it was a $48,000 mortgage, so I think it was 275 bucks a month. And I quickly saw, look, the lender, all the lender cares about is I want to get paid back as the lender. So if the payments are 275 a month and rent is 975, there's a really good chance that the lender's going to get paid back. And so that's what I did for the first one. And that's what I kept doing over and over. Yeah.
So
Yeah.
from 2014 to, let's just say, 2018, so a 4-year stretch, kind
Mhm.
of randomly, how would you estimate the total number of units by that 4-year stretch?
At that time, it was around 35 to 35 units, 40 units in that stretch of time. I bought a single family. Then the next one I did actually was an FHA. So I did a 4-unit FHA. And then after that, I did a 2-unit. And so that was in the span of about 7 to 8 months. So I went from no units and just getting educated, which I spent a year doing before I bought anything, to 7 units within about 7 to 8 months. So that was my initial trajectory. But then I had to figure out the business. I was self-managing. I was trying to coordinate repairs, dealing with the city. I was doing all that stuff, that initial learning, like how do I keep my books? How do I manage a property manager? So initially it took 4 or 5 years to really get to 30, 40 units. And from there, once I knew what I was doing, it was, 5 years later of really grinding it out. That's when I was able to grow the thing.
So you mentioned having a job. So at what point did you have it, like that very first property, right? You had a
Mhm.
job at that point in time working as an
Yes.
engineer?
Yep. And I did up until earlier this year, 2023. So, yep.
So you started out as the worst employee in the world and then became less of the worst employee in the world along the way.
Yeah. Well, that's right. And I was the key to that initial growth. A lot of folks say, I mean, there's two schools of thought: burn the bridges, just go all in. I'm just going to be an entrepreneur. I'm just going to figure it out. That wasn't me. I went to engineering school. I applied safety factors on safety factors. And we learned that in engineering. Like, look, build it as big as you think it needs to be, and then add 20% so it doesn't break, right? So that's what I learned in engineering school. I'm like that by nature. I'm careful. I'm skeptical. I'm always looking at the downside. So I kept my job for a long time. I didn't burn the bridges. I didn't burn the boats, didn't burn any bridges, just kept double hatting for about 13 years before I finally said, okay, I'm going to buy houses, and that's what I'm going to do. And I kept the
So
job for the loans. I kept the job for the money, from the
the
bank
W
money, because
two.
yeah, the W-2, I kept it for a very long time, perhaps too long. But I wanted to know that when I left that role, I would be able to get bank financing.
The Burr method, which is obviously something that's a different lane than what we're talking about. But the Burr method, the idea of having the cash, right? Like, okay, I'm going to go
Right.
buy a property, fix it up, get, get your loan, refinance the money out, get your
Mhm.
cash back, and then go on to the next one, whether you sell it or keep it or whatnot. The question of, okay, getting the next one and then getting the next one, getting the next one, if you're buying and holding these,
Mhm.
how are you continuing to recoup the cash for down payment? Were just saving and increasing income? What were some of your strategies to be able to keep replenishing your cash?
Yeah, that's right. So the best way to replenish the cash is through adding value to the property. So when you buy that property, you have to buy it at a steep enough discount. There's two reasons: either there's a distressed property or a distressed situation. So as the investor, you come in and you solve one of those two things or both, and then you improve the property. You fix the roof, you resolve the heating issues, you resolve the lease issues, whatever the issues are. You fix those. And then you go back to the bank and you say, it's been 4, 6, 8 months. I now have a stabilized asset, stabilized leases. And when you go into that property, you buy it, seeing the end in mind, knowing that I need to get the property to appraise for X, and all my costs are going to be X minus Y. And if all of your costs are X minus Y and the loan is Y, then you get all your money back, right? You just have to make sure that all of your costs, purchase price plus repairs plus holding costs, equal what the loan is going to be. And then you can get all your money back and go do it again. So, and that's what I did many times.
So I do want to come back to some of the processes and books and management companies and things like that. But from a
Mm-hmm.
standpoint of kind of fast forwarding the clock to right now, we're in a time where prices have continued to go up. Rates are obviously a lot higher. You know, rates in the end of 2021 were in the low threes in terms of residential loans.
Mm-hmm.
And then now we're in the sevens and eights. So, I mean, it's just been a pretty drastic, quick, turnaround. From a standpoint of getting in the game right now, right?
Mm-hmm.
How are you viewing this in terms of, let's say you have a first time home buyer that's deciding, hey, I do want to buy. I just don't know if this is the right time. How do you view that question?
So rates right now are historically around their averages. So while compared to the last 10 to 12 years, rates might seem high right now, they're actually not too high historically, looking back. So what I would say for newer investors and aspiring investors is that if you find a deal and it makes sense, the interest rate is just a number on an underwriting spreadsheet. So if the deal makes sense at 7.5%, do the deal. And if you need to find a better deal that's a little bit lower in price, put in the effort up front to find the right deal so that interest rate makes sense and you're not trying to pinch pennies once you buy it because you paid too much. A higher interest rate can be offset by a lower purchase price because then your loan's smaller. You just don't want to get stuck in the situation where you can't afford to do repairs. It's not a good place to be. It doesn't feel good. And you want to offset that higher rate with a lower purchase price. So keep looking for deals.
Yeah, and that's the thing, right? Like, there's just less inventory out there right now, and a lot more stuff is off market. So
Mhm.
you got to be hunting and spending time to find the deals,
That's
and
right.
and that's a time thing, and it's a relationship thing too, right? You're not going to go out there and go find deals. It takes time to build relationships.
Well, that's right. I mean, where do you want I mean, it's if you want to spend your time doing the deals, you want to spend the time going and hunting, that's one thing. Or you could just pay for it by not doing those things and getting a higher rate and a higher purchase price. I just always found that there was more value as an investor to going and finding those deals, going to find those opportunities, solving those problems, because that's where the value is. If you create value for your community and for a seller, you will have a better investment property.
So the last few deals that you purchased, did you buy them on market or off market?
A mix of both, actually. But for the off-market deals, I have a lot more of single families right now. I was buying more multifamilies, but for whatever reason, it's just fluctuated back to single families. And I have purchased a couple 10 or 12 units recently over the past few months that were on market just to kind of exchange or trade up some of the singles into larger assets. So that's what I've been doing. It's kind of both, like finding good deals in single families, but then the other part of my strategy is now that I have those single families, sell them, trade them up, and buy multifamilies.
So the properties that you underwrite, do
Mhm.
they cash flow day one? How are these deals working out in terms of the numbers?
Yeah, a lot of times the deals don't 100% cash flow day one because the rents are either low or the properties aren't rented at all. So what I've done is I've said, okay, well, for the properties where the rents are low, I've gotten interest only type loans, and that could be from a bridge lender, that could be from a private investor. So I've done those types of things to kind of bridge that gap between that nice stabilized asset at the higher refinance price and then what the current rents are. Yep.
And then convert it. Okay.
Yeah, that's right. Yeah, and then refinance it later. Yep.
Okay. Okay. I'm gonna go backwards in time a little bit.
Hmm.
So you get your first one as an investment property,
Hmm.
conventional loan. You get an FHA loan to buy a 4 unit,
Yes, that's right.
and then you bought a 2 unit quickly thereafter.
Yes, that's right. And that was
Uh,
a rehab loan.
So you did a conventional rehab loan.
Yes.
Okay.
So it
Okay.
was through a bank. Yeah, it was a conventional loan that had a rehab component. It wasn't like a 203k, but it was like a similar type product. There's a local bank that specializes in that type of financing.
Was it like how much money did you have to put down for it?
I had to put 20% down.
Okay.
So, and I should add too that personal finance was a huge part of this journey. Personal finance. So I was living again very frugally, like I said before, and I was working my engineering job. And so I was really saving a lot of this cash so that I could put down these payments and these deposits. So that was really important. And I had been planning to do that for a year before I started. So while that growth trajectory sounds fast, hey Matt, how did you buy 7 units in the span of 7 months? I had been really laying the groundwork for a year before that. I had refinanced my car again. I had done a bunch of things and to get that cash so that I was ready to pull the trigger when the deals presented themselves.
And then kind of where did you start to get into more of the commercial private money stuff? How far into your journey?
Yeah, that was like the first after 1 year of investing. So these were conventional loans. They were in my personal name for those first three properties. But then I started buying in LLCs just because I was running out of that conventional loan opportunity. And part of the reason too was that the conventional loans were starting to require more and more down. just the way that the regulations were written at the time. So I started working with commercial banks in LLCs about a year into my business.
Yeah, because on my side, that's one of the questions I get a lot in terms of, okay, do I get my first one in an LLC in terms of rental? First one in an
Right.
LLC, do I do it in my personal name? And generally speaking, I see more people probably be more, better positioned by doing a conventional loan. Yeah, like you mentioned, as far as you can go, couple into it until you start getting into more of your LLC or commercial financing. You mentioned kind of the preparation and the bridge of getting there and the year it took or a year or longer. What were some of the things that was going on in your life that you were digging into, talking to, books? What were you doing to get prepared?
Yeah, I mean, it was all the above, really. I mean, it was just the focus on getting my personal financial situation right. I was focusing on bookkeeping. I was focusing on running the assets. I was learning all about landlording and how to set up leases. And I was just digging in. I was really digging into all of the educational materials I could find so that I could continue to grow. And I made a lot of mistakes. I mean, a lot of mistakes. And I was trying to learn as much as possible to avoid them, but I just set up different things wrong. And I was really consuming as much education as I could. And I still do, but I've made a lot of the mistakes already. So I kind of know, but I was just really cramming down on that education at that time.
Speaking of education, where can people find you online of some of your content that you're putting out?
Oh, sure. Yep. So I'm putting out content on YouTube, on Facebook, on my website. We have a whole blog there, and it's focused on sellers who might be in a situation where they need to sell. But there's a lot of like marketing and other types of stuff that we put out there as well to help others.
And what should they search if they want to find your stuff?
Oh, sure. They can search Pezon Properties. So my email, matt@pezonproperties.com. And then our YouTube channel is Pezon Properties, same with Facebook.
Awesome.
And then our website is pezonproperties.com. Yeah.
From a standpoint of mistakes, right? You mentioned some big ones. Does anything come to mind? Something that just hit you hard at
Oh
that time?
yeah, I mean tons, but I'd say a couple big ones, contractor management. So I had a renovation that was in the winter. This was the 2016 to 2017 winter. I was attempting a rehab and the contractor didn't tell me or didn't say, I don't know which, but it was an oil system. Middle of the winter, didn't say anything. The pipes froze after I'd finished replacing the flooring and ruined all the flooring. And it went down into the insulation. We had to rip out the drywall. It was just a disaster. So just heat management for pipes, that was one. Letting the wrong residents into properties, they not doing full screening, confirming with employment that employer employs the employees, submitting fake pay stubs. I mean, it
Oh,
just goes on and on with having the wrong residents in the properties, working with the wrong contractors, not setting up draws. I mean, I had a reno go on for a year for a flip that I was attempting. And I didn't do any flips for 5 years after that because the contractor, I was paying him weekly. So there was no incentive for him to actually finish the job. And it just dragged on and on. He was taking materials that I was paying for and using them elsewhere, double charging me. I mean, it just goes on and on.
so you go through all that, right? I mean, you're working a daytime job. The work that you're putting in is going to be outside of your normal business hours, and you got a life and family that's coming along the way, and you get married. So, how did you juggle and balance some of these different things that were going on?
Well, I mean, it's a constant juggle and balance. I mean, I was working a full-time job. I was trying to find deals. My girlfriend was becoming my wife, so we had a wedding, and now we have 3 kids under 3. So, I mean, it's just a constant juggle. It's not like here's like you just have to pay attention to yourself, to your family, your loved ones around you, your business, and watch and say, okay, well, if I'm going in this one area too much right now, maybe I need to focus on these other areas. It's not an all-in type of mentality. It's an all-in on all the things type of mentality. So you can't just single out one thing and say, well, I'm just going to be all in on this, because then the other, whether it's your health or if you focus too much in other areas, your business or your turnovers could slide. So it's just a constant tweaking and management of all the areas so that you don't get tunnel vision.
Yeah, and your wife, where does she play in that kind of regulation? Does she kind of keep things in check and give you some reminders along the way?
Oh yeah, I mean, she doesn't hide her feelings. I mean, if I'm not performing in a certain area, I mean, she'll tell me. And it's not that I'm trying to not perform or not do a certain thing or, certain responsibilities, chores around the house or whatever else. It's more just with everything going on, it's easy to it's easy to be reactive and to just react to the next thing in the inbox, the next, hey, got a minute type request. So I've really had to take a step back over the last few years and be intentional with my time. My assistant filters out a bunch of the things that are pulls on my time and manages some of my inbox so I don't get distracted. I like to jump in and help solve problems, but not at the extent of my family, not at the extent of my children. And so I've had to really be intentional with my time like I never have had to before. We didn't have children, we had a smaller business, there was just less on our plate. And so it was easy to get pulled into rabbit holes because I have all this time, right? But now I don't. And so I have to be very intentional with my time. What matters to me, what's important, and not just get caught up in what seems important but isn't, right?
So you mentioned an assistant, right?
Mm-hmm.
Beginning to build a process of, offloading or delegating. Where in your journey did that, start for you?
Only about 6 to 9 months ago, we actually have twins. They were born last month. And I spent the better part of this year building up those systems and processes because I was still going out to look at all the properties myself. And I was still responding to all the emails and I was still putting together all the loan request packages myself. And I knew not in 9 months, which was in October. So January, I knew in 9 months, I wasn't going to be able to do those things. And I wanted to invest back in the business so I could set up and train people in advance so that they could do those things. And up until 9 months ago, I was rather selfish. I was taking away opportunities from other people by doing all the work myself. And I had to shift my mentality over the last 9 months by not taking all the opportunity for myself, but giving it away. And once I made that mentality shift and I could empower others and train them and coach them, it allowed me to build a system, have an assistant, and coach others and train others and build an organization that I hadn't really done up until this point. And I'm glad I did because now it's tricky, right? So I'm thankful that I took that 9 month stretch of time and I wasn't doing as many deals. So it was hard to see that payoff because, well, hey, business is dropping, I'm not doing as many deals. I need to be out, pounding the streets, doing more deals. And I knew that I needed to be more intentional and plan for the future. And I'm glad that I did.
So you mentioned a few of the things, emails and, loan package requests. I mean, those are some of the things that you've trained your team to do on your behalf?
Yes, that's correct.
What are some other things that come to mind that you've been able to kind of implement?
Yeah, similar things like that. Initial underwriting screening, like is the property one that I want to pursue? Also, I have two acquisitions managers that we've broken up into two territories. So they do that initial lead cultivation. So they're having the conversations, going to the properties, making offers, negotiating. So that's kind of front end, finding the deals and then managing the day to day with the inbox. But also on the back end, there's all the follow up. Like we need to upgrade this heating system before winter. Well, I used to put all that stuff in my personal calendar and I was just getting bombarded with these constant reminders. And then now I have to go chase down contractors and, oh, let's get electric bids. And so I've set up a system. We use Asana for task management. And then I have an operations specialist that follows up on all those tasks, 4 months later, 5 months later, and gets them done with the property manager. So it's really been full life cycle, hiring and training and coaching acquisition managers, managing the day to day, and then managing the future tasks and the follow up that I've really honed in on. And we
So
could dive into that more if you want, but that's kind of the architecture.
from a property manager standpoint, you mentioned property manager. That's in-house, right?
No, we hire a third party property manager, but you still have to manage the manager.
Okay.
What units are vacant? Who's doing the turnover? How soon can you get to them? If you can't, who can we hire to go in? What payment issues are we having? What maintenance upgrades do we need to do? All those things, they handle the day to day, but you still need to manage your asset.
So what if you're building systems for these types of things for the acquisition side of it, I guess
Mm-hmm.
that's an intentional choice of not to do that. Is that a time thing? Maybe down the road you bring that in, or what are your thoughts on the
Oh, on the
management?
property management side,
Mm-hmm.
it's just because I found that. So when I was doing my full time job, the way to eventually get out of doing that full time job was having enough rentals. And if I spent all of my time managing the rentals, I wasn't finding the deals. So I chose deals and finance, and finding the right deal and then getting my money back through the Burr refinancing. And I third party managed everything. And to a certain degree, I'm going to retain that model because I could maybe save, let's say, $50,000 a year or 70,000 or even $100,000 a year by insourcing management. But then now I have to build that whole widget, and I have to hire people for that widget, and I have to now not focus on doing more deals with my team. And maybe that's 2 deals a year would recover that profit. So my focus has been on sales, and it probably will continue to be on that sales growth, because 1, 2, 3 deals could recoup that potential profit from management, and it's a lot less time to do so.
From a standpoint of deals, right? Like we're in this time where the amount of deals is lower than it ever has been for a long time.
Mm-hmm.
In terms of markets, are you guys hyper focused on the current market in Allentown, or potentially expanding, or what are your thoughts on that over time?
Yeah, we're actually expanding to other markets just because the Lehigh Valley has become quite competitive. There are other markets nearby that aren't as competitive. So I've gone up to the Wilkes-Barre, Scranton area, purchasing multifamily properties there in really good neighborhoods, like close to universities and things, and also out towards Reading a little bit more. So, and further west. So just trying to go to other markets that are in the path of progress, but that as aren't as pricey, I'd say, but the ability to do that Burr method is there in those markets. So it's just tricky today with where pricing is in the Lehigh Valley to build out a Burr model successfully.
If somebody came to you and said, "Hey, you know what, Matthew, I want to try to attempt what you've done, that you started back in 2014, and I want to potentially try to do that and build something starting today." Do you see that in these markets right now that's possible?
I do see it as possible. First things first, you have to be in the right market. So it would be really difficult to build out a rental model with Burr in like a coastal market that's higher priced. It should be something more inland, Midwest, South, for that model, that specific model to work. After you find the right market, then you need to have the right team and the right people. So that's bankers, obviously. So you want to be getting really smart on how to talk to bankers, what they want to know, and how you can do Burr successfully. And you need to interview 10, 15, 20 bankers and find one that or 2 or 3 that you can work with. And then after that, it's really the property. And then so now you need to find a right property that fits that model. And to do that, you need to be a good marketer. You need to understand how to find people that are either in a situation themselves or have a property that needs to be repaired, and then get in front of those people and buy those houses that will make Burr possible. So it's not just marketing is like the third thing or fourth thing. Really, it's being in the right market with the right team, and then marketing to find the right property.
And you mentioned the banking part of it, and I don't think enough people talk about that in terms of the science. I mean, that's like the language of the elite, understanding finance.
Yep.
And what type of advice, or what are some of the things that you would want to share and advise somebody to know about?
Right. You need to understand the ins and outs of the loan products and how banks do underwriting for the property. So you need to understand things like the debt coverage ratio. Basically, the lender is going to say, well, how much is all of our mortgage payments? And then we need the borrower to make 20% more than that. Otherwise, they can't pay us. So you need to understand those basic principles. You need to understand the loan terms, because it's not just interest rate. I mean, the interest rates, that's like almost the last question I asked the bank, because it's just what market rate is. It's more like, what LTV will you lend up to? Will you do 80 LTV? Will you do 75? Will you do 70? How quickly will you do a cash out refinance? Do you do a cash out refinance? And then what are the terms associated with that? How long will you lock your interest rate for? Will you cap your interest rate? Things like that. Will you finance all the construction costs or 80% of the construction costs? There's all these different variables. So for the listeners, definitely get educated on how the money works, because the property is important, but what enables the property to be yours is the financing. So I almost backdoored getting to the property. The property was like, it wasn't one of the things I started with. It was, okay, What do I want my market to be? Who's my team? How do I get these loans? How do I get my cash back out of these loans? And then how do I get in front of sellers? I mean, it's the money, the bank money is how you buy. So you need to understand that component. Otherwise you can't buy, or you can't buy right.
So the renovation part of it, and contractors and dealing with that, kind of what's your philosophy right now in this market? And because are you still outsourcing, or do you have anything internal?
I have not started a construction company yet. I've been fortunate to work with really good contractors today after making all the mistakes in the book with how many other contractors. I mean, I could go on forever about that. But I found a core group of contractors. I work with 4 or 5 different crews, and it's just constantly on recycle mode. I mean, they know that there's repeat business, and so they want to just keep working with me. And we built a relationship over 6, 7, 8 years. So it's tricky. So what I'd say for finding good contractors, I would just go to Home Depot in the morning and talk to people, go at 6:30, 7 in the morning. And all right, who looks like a contractor and is out early buying materials? Because don't show up at 10 a.m. Who's buying? Because that means if the contractor shows up at Home Depot at 10 a.m., they either forgot stuff, so they don't plan, or they're just getting started for the day. So I've met contractors that way through my networks, through referrals, through local meetup groups. And then you just start talking to them and set up the terms. Like if they want 35% down up front, no, because it's 15% down tops, because they're taking your deposit to pay for the prior job that they ran out of money on, is basically what happens. And I've seen that happen over and over again, robbing Peter to pay Paul with these guys. And it's just, look, 15, 20% down. And if they need more than that, I wouldn't start doing business with them.
Yeah, yeah. And there's so much that goes into this process that we could probably dig into.
Yeah.
I think the biggest thing is, when I talk to people like yourself who have been doing this for a while, right, have, gone through the ups and downs and the failures that you mentioned before, I'm sure there was probably doubts along the way, or second guessing yourself along the way, and those things happen. But how would you kind of talk about that stuff?
Yeah. I've, if you're not second guessing yourself and you're all in, and you just, there's a healthy degree of skepticism before it bleeds into cynicism. But you can't just be a skeptic without seeing the upside of what you're doing. So I found this, it's almost like 2 different personalities that you have to have. You have to see the upside. You have to see the path forward. You have to see the opportunity. Otherwise, you'll never get started. You'll scare yourself into inaction. But if you only focus on the upside, then you won't potentially see dangers and pitfalls. You won't dig into the details as much because, oh, well, I'll just do the next deal if I can't make up for this deal that didn't go well. And you can run out of cash. You can get yourself into a bind. So you have to look at both. You have to see the business case. You have to see the upside. I'd say I focus probably 20% of my time on the upside and 80% on what can go wrong. And you have to do both, but you can't do all one or all the other. Otherwise, you're going to end up in inaction if you focus too much on skepticism, or you're going to burn yourself if you don't do your due diligence and focus on all the upside.
Yeah, so it's a delicate balance, right? I mean,
Yep.
you got to find the deals. We got to find something that worked, and you guys take 2 feet and jump in.
That's right.
To that first one.
Yeah. And the more you can get educated and the more confidence you can build, and just go look at properties, see what pricing is, look online, see what's trading for what amount. And then you can spot deals faster by doing all that preparation, and just submit offers. I mean, you can work with a local realtor, or you can submit them yourself. Just go online, find the listing agent, and just submit offers and see what happens. And you'll start to get a pulse on your market versus just waiting around. Oh, I can't find a deal. Like, how many offers did you submit this week? Right. If it's like under 3, then you need to take a serious look at why it's below 3. Oh, I can't find any deals. The market's too tight. Well, how many offers did you submit? Like, I hear that all the time. It's like, oh, I can't find any deals. Well, how many offers did you make? And so
a couple of things. So the deal and submitting an offer, I want to come back to that in a second, but from analyzing the number standpoint, one of the things that I look at, when I looked at short-term rental stuff in Florida, I'll look at the projected rents off the bat, just take 40% off the top, and then look at the net number of 60%, and then compare that with the mortgage payment to kind of just get a rough ballpark of the numbers. How do you look at stuff? Do you have any kind of quick, calculations that you do to kind of run numbers if you're looking at a property?
Yeah, I do. So and obviously we have some spreadsheets and stuff, but pretty quick. I mean, we'll just take the fair market rents off HUD, like HUD's website. We'll look at PHFA and rentometer.com. We'll kind of take you know, because a lot of times the property is either vacant or rents are low. So we'll say, okay, where do we reasonably think rents are? And we'll discount them, usually 10, 20%. And then, like you do, we'll say, okay, let's assume that half of our rent goes to expenses. Where does that put us with our mortgage? Like just back of the envelope. So if, we'll discount rents 10, 20%, say, all right, take half of that off. That's what we have left to pay the mortgage. How much of a mortgage can we get for that once we factor in the fact that you need 20% more income than the mortgage? And so just a couple math steps, and then we know about what we can pay.
So in this market right now, there are deals out there that you can get the numbers to work with. If you're discounting 50% off of rent to rents, you can make the numbers work even with these rates right now.
Well, so that's the thing, because the rates are high. So we've started asking our lenders for interest only periods so that we can raise rents over time, because it's tough to, unless if you want to have an 80% vacant property, if you raise rents too fast and don't do repairs, you could have a lot of vacancy. So we've asked for our lenders for interest only. And there are some bridge lenders that will do 2 or even 3-year interest only payments before like the interest rate would reset. And there's even 10-year fixed interest rate loans. Mm-hmm. So we've started exploring those because it's really difficult to get that principal interest payment to cash flow. And I'm not saying overpay, but if you're within 5% from what a seller wants and you really aren't going to get it to cash flow, and now you might have to put 30% down instead of 25, you might try a 10-year interest only loan. Mm-hmm. And now you can put down 25% so that you're not putting 30% down, right?
So for people out there that are listening to this that may not be in kind of this commercial lending game, mortgage rates for primary residents have been in the 7s and 8s, in 6s, depending on how much you're going to pay in points. What kind of rates are you seeing from a commercial lending standpoint?
Right now, around 7.5%, 7.6%. One or two lenders that I work with, I don't know why, but they have a 10-year fixed interest rate product that's in like 7.3%. And I don't know why it's lower for 10-year fixed rate. So I've been doing that a little bit more. But for a starting investor, it might be high 7s, low 8s. But that's about what I'm seeing for rates.
Yeah, because prime's at 8.5. So I mean, if you can get a rate under prime, I mean that's not bad at all.
Yeah, that's right. I mean, it's, and some of it too, I don't want to set unreasonable expectations. I mean, some of it is a little bit of just my relationship with the lenders. But yeah, I mean, it can be difficult to get properties to cash flow. The biggest problem that I see is a little bit of like lazy owner syndrome, where the owner says, well, I have these rents at 25% below market. They could be 25% higher. So I want full price. And I have to explain to these sellers all the time, but I can't get a loan. They're low maybe a year and a half ago, but unless if I'm going to put 45% down, good luck finding a buyer who will do that.
Yeah.
So there's a gap right now between sellers not understanding that the buyer can't get a loan typically and what they want for their price. So I've tried to bridge that gap a little bit with some of the loan products that I just mentioned, but it's a little bit of like sellers and buyers are playing chicken a little bit. And plus there's little inventory. So there are fewer sellers to work with. It's a little bit of a tricky time, but again, going back to the marketing thing, if you get in front of the right sellers, maybe you can get them to carry back financing. That's another thing that I'm exploring right now. I never used to do that. Why would I do that when I could just get money from the bank at 4.5%? But now I'm working a lot more with sellers to carry back a note. So trying to just bridge that gap.
So put 40% down and then have a seller carry back 10 or 20%, whatever the number, some type of combination like that.
Yeah, that's right. That's right. Assuming the lender will allow it. So I'm exploring all these different options right now, between interest only, seller carrying back a mortgage, and also just explaining to the sellers, but your rents aren't at market. I can't pay you for something that isn't there. The lenders don't allow that. So, yeah.
So the biggest thing that I always tell people about the real estate game is that it's all about time in the game, not trying to time the market, getting in the game and letting time work for you. Mm-hmm. And, there's no better time. If you don't own anything right now, there's no better time than to own something soon, because it's not going to get it any cheaper. Yeah. Now, obviously there could be dips in markets, but at the same time, like getting into the game, and looking at it 5-10 years down the road, that's the key. And like me personally, I didn't have a mentor. I bought my first house in 2009. I bought my next one in 2013, turned the old one into a rental, did it
Hmm.
again a couple years later. So it's something that I call the stair step method: buy a property, live in it, for a few years, save up, buy the next one, turn the old one into a rental. And, there's people that I know that are similar in age than I am. I just turned 40, and I was able to kind of see a vision, read the books, whatever, and do it and just make it happen and keep going. And there's so many people who sell their property to be able to get into the next one. And then so they're not owning and carrying anything. They're just getting into the next one clean, which is fine. Right. But when you look at 10 years, a 10-year time span, if you have a couple purchases and you're letting the other one go, that's potentially a missed opportunity for equity buildup. And I use the term, eye the storm, like in the first 5, 6 years, I didn't know what I was doing. I was
Yeah.
working on my job, I'm just focused on paying the bills. I didn't really realize, values were going up, renters paying your mortgage down. Like, oh, I actually have something here. It wasn't until probably 2018, 2019 that I was like, oh, shit. Like, I need to keep going and putting my dollars towards this. And because it's a slow game and you don't see the positive compounding in the results right away. For you in the cash flow game, like you saw the results right away in your market. But kind of any thoughts on that kind of mindset of just looking at time and using it to your advantage?
I mean, there's so much there. There's a lot of gold there. It's difficult if you look back at median housing prices to find a 10-year window of time where, and I don't even think it exists, where prices didn't increase nationally. So there's a lot of reasons for that. But I would say that someone's a phrase that I learned or that I heard that I thought was valuable. I don't know who said it, but I said, don't wait to buy real estate and wait. And I think there's a lot of wisdom in that phrase. You can't buy a property that doesn't cash flow and is now maybe you can in certain markets. It's not the model I did, but you can't be constantly dumping money into the property in order for it to be mostly sustainable over time. But even properties that don't cash flow too well tend to go up in value. And I just think it's about getting in, being smart, especially for your first 3, 5, 10 properties. Make sure they're cash flow positive. But I mean, time heals many wounds in real estate, and it's a very forgiving asset class. It's why I love it. And time is a big benefactor to the real estate industry.
Is there something that you would do different if you could change one thing? Is there something that you do different looking back?
So I actually, yes, there is. For the first 8 years of my investing career, and in the Allentown, now it's market specific, but we had seen appreciation of 12 to 14% every year in Allentown. And I didn't refinance properties as much as I should to redeploy capital. And I probably could have sold not a lot more, but a couple more properties that had appreciated. I let the properties stay on my balance sheet without refinancing them and without selling them, and they were inefficient. There was a lot of opportunity cost for not liquidating an asset or refinancing an asset to buy more. Instead of having 10 single family homes cash flowing at 1,000 a month, I probably could have had, let's say, 15 at one time cash flowing or rented for 1,000 a month if I would have just sold a couple more and purchased a couple more. But instead, I ended up with fewer homes with more equity in them. And not that's bad, but I probably could have bought more if I would have.
Yeah, I mean, obviously hindsight's 2020. You just don't know what's going to happen. I mean, I remember back in
Yeah.
2013, um, personally just thinking to myself, hey, like something's going on in the market. It feels like there's going to be another dip, like that 0809 thing.
Mm,
For me personally, just it stuck with me. Like I started putting money in the markets for the first time in 2007,
mm-hmm.
and it wasn't a lot of money, but it was all money I had, in terms of extra. And I went to 40-50% of that within a year and a half. And like I
Mm,
just always had this kind of distrust with the markets and just this uneasy feeling of deploying it, right? And so it's like that same kind of thing. You're like, okay, is it going to happen again? Is it going to happen again? And obviously it didn't happen again for how many years till we are right now, right? So it's just there's no way to know what's going to happen. And you mentioned reserves and just having the liquidity to be able to really weather the storm and things don't go right, because things are always going to go wrong. I mean, there's always something that happens and you have to be ready. Any advice or tactics on how you look at that or attack that part of it?
Yeah, on reserves, yeah, it's Murphy's Law that anything that can go wrong will go wrong. And I've experienced everything from fires and sinkholes and people getting unfortunately shot and other things in and near my property. So it doesn't happen every day, but stuff will go wrong. There's just been so many other issues. And so the rule that I set for myself is I want a minimum of 6 months of all of the expenses, and not just mortgage expenses, but taxes and insurance. And I'm just going to maintain that as my minimum threshold for liquidity. And then after that, I'll invest anything else where it makes sense. I probably could have lowered that threshold a little bit to buy more earlier, which goes back to my regret. But I would rather miss a deal and stay in the game than get wiped out if something goes wrong and I wasn't prepared and didn't have reserves. So going back to that kind of engineering mindset and that buffer, and I want that safety factor. For me, the reserves were always the safety factor. I always wanted to have a little extra dry powder for a rainy day, and that's just how I've operated for almost 10 years now, and I don't regret it.
That's awesome. And real estate, right? It's not for everybody, but the people that want to get into the game, right? It can be so fruitful. I mean, you're 36 and you just quit your full-time job. I mean, like that's freedom, right? To be able to go do what you want to do, not have to clock in, clock out.
Right.
So how do you describe, that part of this journey?
Yeah, so going back, so it wasn't just a job for me, and it never was. So I would encourage anyone who's getting into the real estate business and they're working a full-time job, which is fantastic. It's a huge asset for getting banks to lend you money. Pick a job where you can learn valuable skills that will benefit your real estate investing business. So in my case, I mentioned processes and systems and having an assistant and the training program that I've built for my team in different roles. All that was because I was a manager at one of the largest industrial gas companies in the United States. And so to manage 6,000 tanks that were ours, plus all the other ones, maintenance programs, all that stuff filtered through my team. We used SAP, we used Salesforce, all these systems and processes. And so that was one thing that I always gravitated to and I wanted to learn in my full-time job. So while you're in that phase, and you'll be in it for a while, if you don't take the burn the boats approach, if you take the full-time job approach, you will be in that job for probably 5, 7, 10 years, depending on your growth trajectory at a minimum. For me, it was 13. So make sure you're in a job that is building the skills that you'll need to be a successful investor. It could be in finance, it could be in debt, it could be in banking, it could be in an operations type role, it could be in a sales role if you're really looking to get into marketing or digital marketing. It could be in various roles. Leverage that job because it's going to be a while before you're a full-time investor. Learn the skills that will help you build an enterprise in the future and take advantage of that W-2 time.
Is there anybody around you in your networks, your circles, friends, family, colleagues that never had real estate in their mind or vision? And
Oh yeah, I mean, well, I'm one of those people, but another one of my colleagues, and he's referred me probably 30 units off of deals that he doesn't want to do. He's in affordable housing, and he's a guy like, we have a lot of mutual respect because he and his partner have bought hundreds of units, and he didn't start from anything just like me, and now he owns hundreds of units, and he was the first year out of college for him, he lived in his renovation, and he would work all day and then get takeout. There was no kitchen, and he would sleep there. And that was what he did for that first year. And then he started buying properties on the block. It was by a university, and then they owned the whole block and rented it to students, and they did really well. And so that's just another example, but there are others. I mean, I teach real estate at the real estate lab in Allentown, and I help people get started investing in real estate. And I see them, they didn't grow up learning about real estate or know, but they're curious about it, and they see how real estate can benefit them. So I try to help others in my extended network get started in that way too. So
that's awesome.
Yeah, it's a great business.
So any big goals for the next year coming up?
Yeah, so really hone in on our processes and systems, training my team and having them competent, and they already are, but become like world class at what they do. So that's my main goal over the next 6 to 9 months. and also start buying bigger deals. Once my team, they're connecting the dots. Once they can really start, oh, they can see this step leads to this step to that step and how they all fit into the big picture. And they can start operating on these single families, duplexes, smaller packages. I want to buy bigger deals. So I'm looking to phase up to, 20, 30, 40, 50 unit communities and start going in that direction. My deal buying arm is really to find deals and create value, create equity, sell to owner occupants to kind of recycle out of landlords or people that have let their houses decay into like an FHA or end buyer, kind of increasing home ownership, and then using the proceeds to buy apartments.
That's awesome. That's awesome. Last piece of advice for somebody that wants to get into real estate.
Education. Easy for me to say because I've spent years educating myself, but because of that time, get educated, learn about banking, learn about management, learn about finding good deals. I mean, I'm just constantly devouring stuff, learning new tips and tricks, meeting with people in my network to learn. And so I'd challenge everyone to really get educated and not just learn for the sake of learning, but apply the knowledge, execute on the knowledge, take action, and you can succeed. I didn't grow up with anyone buying real estate in my family. No one knows how to do this in my family. They still don't. It's you can do it. You can do it. Just get educated and learn.
I love it. I love it. Well, thank you so much for taking time out of your busy day to join us. And Matthew, can't wait to have you on down the road and see some more of your successes.
Thank you so much for having me, and I hope to have added value to your listeners.
All right. Take care.
Thanks, Joel. Take care.